Stocks posted their first back-to-back weekly losses since February. Joining us now is Valerie Grant, Senior Portfolio Manager at Alliance Bernstein, and Greg Branch, Managing Partner at Veritas Financial. Reading through this, I think both of you are at least aware of the I word in inflationary expectations, and that's the first thing I saw this morning. We're seeing more and more talk, signs of inflation threaten investors' portfolios. Greg, I always sort of misinterpret, I think, how concerned you are about certain things, but you seem to think that inflationary expectations are underappreciated. Do you think it's going to be more than transitory? Are you getting a little concerned?
I am concerned, Joe. One of the primary legs of inflation has yet to kick in. When we look at the housing component, typically rents lag home prices by about 15 to 18 months. And so we've yet to really see that kick in force. The prospect that we are not raising rates until 2024, 2023, I think, has been summarily dismissed. I think that you will see the Fed start to aggressively change their posture this year. I think that we will see rates being raised next year. And so the challenge will be, when does the market start to anticipate that and digest it? And what are the opportunities that we can take advantage of when that happens?
Valerie, inflation in the past, if it's just within a range, is not necessarily bad for stocks. In fact, I think sometimes it can be good for stocks. Companies might be able to raise prices, and we're at such low levels, and we've been here for so long that no one's talking about 70s hyperinflation. However, once you see any type of nascent inflation, you worry about the Fed. That's what it is, right? We're worried that the Fed, we're still addicted to all this cheap money. And so even if inflation only goes to 3, 3.5, 4, and stays there, that may not be that bad, but it's bad because it takes the Fed out of the picture, or brings the Fed into the picture.
Well, I think we definitely have to monitor the monetary policy, as was mentioned previously, although it's very difficult to predict, how the Fed will act. I think for me, the more important issue is trying to unpack which parts of the inflation are transitory and which parts are likely to be permanent. We know that we are confronting supply chain constraints and other disruptions, which is also leading to inflation. Energy prices are rising as well due to some exogenous effects. I think those things are transient. Eventually, we'll see aggregate supply increase to meet aggregate demand. However, one area where I think we will have inflation on an ongoing basis is in wages and labor costs. What we saw is that pre-COVID, many companies were over-earning by paying lower wages and benefits to their employees. And right now, what we're hearing from CEOs and CFOs is that they are really having to raise wages in order to incentivize people to come back on board as the economy is getting back on its feet. So I think that the wage inflation will likely be a permanent after effect of the COVID-19 pandemic.
You're still finding some both value and growth areas, Valerie? It's kind of not either or.
I don't believe it's either or. We are seeing value stocks and growth stocks work at different times and on different days, quite frankly, of the week. So I think that there's a lot of opportunity for companies that are focused on innovation and that are perhaps trading at high multiples, but they'll likely earn their way into those multiples. But also some of the value stocks have just been phenomenal in terms of the recovery, again, as the economy has reopened. So it's nice to keep exposure to both because at various points in time, both factors are actually working quite well.
Greg, you think we are going to have a kind of a summer of discontent where it's not necessarily, maybe by the end of the year we're better off, but we're in the middle of some kind of, a pullback, doldrums, a consolidation, or have I got that wrong?
We don't know yet. We'll have to see what the May data looks like. I agree with Valerie that while we have caught up in terms of the multiples, consensus is still light in the back half on many sectors and on many individual growth stories. And so we can get performance in the back half driven by the upside revisions, driven by earnings surprises, driven by them earning their way into it, as Valerie referenced. In the near term, if we have a beat on the CPI of the magnitude that we just witnessed, now we're talking about 5.5% to 6% year-over-year inflation. And granted, the base effects will contribute to that, but we have to start wondering, we have to start digesting, is it going to average out somewhere above the 2.2% or so level that the Fed said that they are comfortable with? And I think that we'll go through the fits and throes of trying to figure that out over the summer.
Shepard Smith here. Thanks for watching CNBC on YouTube.